Hello, I'm Craig Stetson with Capital Edge Consulting. Welcome. We're here today to talk about a pending change in the definition of deficiencies relative to business systems for government contracting purposes. This is a 2001 NDAA National Defense Authorization Act change. The NDAA is set for signature. It's about that time of the year. It's usually done around late November, December timeframe, which is where we are, assuming that President Trump doesn't veto this thing. There was a subtle threat of that recently regarding certain aspects, that he did not agree with. But let's just assume that the NDA is going to be signed. It'll be effective in law then this month. And what we want to talk about today is one of the provisions, Section 845, which seeks to change the definition of what the criteria that the government uses for purposes of determining if a business system is adequate or not. Right now, that definition is significant deficiency, and that's been the definition since inception of these rules in early 2012, February 2012, so almost 9 years ago. Significant deficiency is the term and the definition that's applicable to determination of a contractor's business systems. And what all this really means is, if significant deficiencies are found in a business system, then the consequences may be financial withholds on payments under certain types of contracts. So it can be a big deal cash flow wise. Also, if the system is determined to be inadequate because of the presence of significant deficiencies, other bad things can happen. That goes into the government's database. Everyone knows then that, contractor, XYZ has an inadequate system. So obviously we want to avoid that. And the systems we're talking about, there's 6 main systems that are relevant for government contracting purposes: accounting, estimating, purchasing, material management, earned value, and government property. So those 6 systems, at least in the DFARS and the Department of Defense world, are all governed by their specific clauses that are in certain contracts, CAS-covered contracts. And then there's also a business system clause, which allows the government to invoke the withholds for systems that are determined to be inadequate. So the problem here is that significant deficiency in this context is not consistent with the rest of the world. The private financial and accounting world, generally accepted auditing standards, what CPA firms do when they perform financial statement audits and render opinions thereon. There's a different set of standards, similar terminology, but they mean different things. So one of the initiatives that has been around now for a few years anyway in the various annual NDAAs are attempts to align government contracting, different aspects of government contracting, with financial accounting, with commercial accounting practices to make them consistent. And this is just one more attempt to do that. And this latest, this change from significant deficiency to material weakness, the root of that is the now dissolved Section 809 panel. They issued their final 3 of 3, volume 3 of 3 early last year, 2019. And one of the recommendations was to do just that, was to align how internal control definitions are currently defined versus the way they are in the private financial world. So to bring alignment there. And the way to do that, one of the recommendations was to change significant deficiency to material weakness, because it means different things to different people. Significant deficiency, as is defined right now in the DFARS, is not consistent with material or with significant deficiency as is defined in generally accepted accounting standards or auditing standards. So it's confusing to people because there are other parties that perform audits of internal control. Someone may be looking at it from an M&A due diligence point of view. An internal auditor may be looking at it. Other outside parties besides the government. And with that inconsistency, it's difficult to really understand, well, in this context, significant deficiency means this, but in another context, it means something else. So, and it all has to do with severity, the severity of the gap or the non-compliance. So to bring consistency between the two, the recommendation is to change significant deficiency to material weakness, because the way significant deficiency is defined in the DFARS right now, the equivalent version of that in the financial reporting world is material weakness, which is the most severe. And in the financial reporting world, if there is a material weakness, then the company is required to do certain things, one of which is to report that non-compliance to the SEC, a public company. So you're required to report gaps in internal control when they're determined to be a material weakness, required to report that to the SEC, but you're not if it's a significant deficiency. So right there, there's an inconsistency. So that needs to get fixed. That's the point of the recommendation. So we're at the beginning of that right now. The NDAA is just simply the statute. We're going to sign into law that this standard is going to change from significant deficiency to material weakness. So how do we make that happen? Well, that's the next step. That's the proposed rules that you would expect to see, published in the Federal Register. That would then amend or revise, the DFARS in this case. So we would expect to see that next year. But in order to make this meaningful, we simply cannot go only from significant deficiency to material weakness. That's one data point, which is the way it is now, and that's not right. I mean, there are different versions of internal control gaps that are out there, and in the financial reporting world, there's basically three categories. There's other deficiencies, which can be something trivial, really not significant at all or material. Then there's significant deficiencies, and then there's material weakness. So it's a three-tiered approach, as to the severity of these internal control gaps. So it's important to maintain that or to bring that over into government contracting so that every deficiency then doesn't just automatically revert to a material weakness. There are other things to look at. There are other considerations. And yes, a lot of this it's very subjective. It's professional judgment. It is in the eye of the beholder. What is significant or what's a material weakness? Those lines get blurry when you cross one into the other. There are several things to consider. But without those fundamental definitions in the DFAR, no one would even know that those other considerations are out there. So to make this, like I said, to make it meaningful, there's going to be several definitions that need to be updated and included in the DFARS as well. So it's not just simply what is a material weakness, it is what is a material noncompliance, because that's the underlying criteria embedded in the material weakness definition is a material noncompliance. Well, what does that mean? Okay, so there needs to be a definition for that. There needs to be a definition for what is a significant deficiency in accordance with the financial reporting standards, generally accepted auditing standards. And then what is an other deficiency? We need the full context included in the DFARS so that when outside parties or government auditors are reviewing or assessing internal control, there can be a meaningful, reasoned decision where you can have, you can compare different data points to be able to make that decision as to really, what is a material weakness. And, really, I mean, that's what's important here is you want to minimize, obviously, or avoid material weakness determinations, because in the government contracting world, that can revert or result in withholds, financial withholds under certain types of contracts. And when all this started, in 2012, the government, the DCAA, they were very active in reviewing, auditing defense contractor accounting and estimating systems, and the withholds resulting from those audits for the large defense contractors, the name brand ones that we've all heard of, was several $100 million. So even for a large Fortune 100 company, hundreds of millions of dollars is a big deal from a cash flow point of view. So it can be significant. So to avoid that, we need to bring better conformity, better consistency as to what it really means and how it's applied day to day. So if I'm a contractor, what do I want to do? I mean, I know this is coming. This change, this proposed change from significant deficiency to material weakness, it was in the original NDAA. It remains in both the Senate and House versions of the NDAA. So the only thing left to do really is to conform and consolidate the NDAA and make it ready for signature by the president, which from everything we've seen is close. That'll be this month. So it's kind of a foredrawn conclusion that this definition will change. So we should see the proposed rules that will be sent out for public comment. We should see those next year sometime. So in the meantime, if I'm a defense contractor, just as part of my monitoring process of my business systems, my self-assessments, I want to start thinking about this change and what it really means and go through this risk assessment approach as to how I look at compliance and categorize my risks of my business systems along these new lines, not new from a financial reporting point of view, but new from a government contracting point of view. Start to do that, start to document, why something, may be a significant deficiency and not a material weakness, and have reasonable explanation and documentation as to why you believe that. Because, I mean, like I said, these standards are going to change. And we need to be able to provide, support to the government auditors when they come around. And, they may be somewhat biased and want to jump to the most severe form of a non-compliance when that may not really be necessary, considering the broader now definition. Hopefully that will become the new standard. So that's it for today. Thank you very much. Certainly reach out to anyone here at Capital Edge if you want to discuss further or have questions. Thank you.